This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hi everyone, welcome back to my channel. In today's video, I want to talk about an adjustment in my own portfolio. I am planning to sell QQQY. But before I talk about what I will buy next, I want to explain why QQQY no longer feels like the best fit for my portfolio. QQQY is not a bad product. I bought it for a clear reason. I wanted Nasdaq technology exposure, but I also wanted more stable cash flow. Technology stocks can be volatile, and for a high-income portfolio like mine, that volatility can make the income experience less predictable. You can't predict the stock market. Nobody knows for sure whether stocks will go up or down tomorrow. But there is one thing you can lock in, which is free rewards from Moomoo. Right now, Moomoo Canada has a limited time promotion from June 1st to August 31st. When you open an account, you can get a 30-day free commission card, plus 30 days of 6% APY cash sweep. And when you make your first deposit, you can receive free stock rewards. Deposit 1,000 Canadian dollars and get 10 free shares. Deposit 8,000 Canadian dollars and get 30 free shares. You may even have a chance to receive popular stocks like SpaceX, Tesla, Nvidia, and more. Moomoo supports cash, margin, TFSA, and RRSP accounts, and it is regulated by CIRO with CIPF protection. Besides the welcome rewards, I also like that Moomoo lets you follow market-moving news in real time, and their ETF screener is very convenient for comparing ETFs. Interested? Use the link below this video to sign up and claim your rewards. Someone on Blossom once asked me why I held QQQY instead of QQCL. My answer was simple. I trusted Evovle's covered call execution. QQQY had very stable distributions, and its underlying index QQQ.T was strong. Even without QQCL's leverage, it still had the potential to deliver similar long-term performance. So instead of taking on QQCL's leverage structure, I chose QQQY. It gave me a more moderate way to hold technology exposure and receive stable monthly income. Like many Evovle covered call products, QQQY's biggest attraction has been distribution stability. At least so far, QQQY has never reduced its distribution. It has paid steadily every month. That was the main reason I bought it. I accepted some upside sacrifice in exchange for more stable cash flow. The main reason I am selling QQQY now is that after the recent technology rally, it has clearly lagged behind QQQ.T. Based on my backtesting tool, QQQY's total return so far this year is about 14.98%. That is not bad, especially because it includes reinvested distributions. But QQQ.T is up about 24.43%, and QQC is up about 21.85%. So QQQY still made money, but it did not keep up with the underlying technology rally. This is the part one care about most. QQQY can write covered calls on up to 50% of the portfolio. For me, that ratio now feels too high. In the past, I could accept it because I cared more about distribution stability. But the market is very hard to predict right now. Even Evovle, which I respect as a covered call manager, cannot perfectly predict the market's rhythm every time. Sudden rallies are not something anyone can reliably forecast. If the market rises slowly, a covered call manager may still have room to adjust coverage and strike prices. But if the market suddenly moves sharply higher, a 50% covered call ratio can give up a lot of upside very quickly. So I now prefer income products with lower covered call coverage. Distribution stability is still important to me. But if I have to sacrifice too much NAV growth, the trade-off becomes less attractive. If we extend the period back to October 10, 2023, QQQY's total return is about 107.57%. QQQ.T's total return is about 136.57%. QQQY has still done very well. But if the goal is long-term technology exposure, the gap matters. QQQY also does not use light leverage to offset the upside lost from covered calls. For an income investor, distributions matter. But distributions do not come from nowhere. Long-term cash flow eventually depends on whether the NAV can hold up and whether the underlying assets can keep growing. Another change is that QQQY's NAV has moved higher, so the yield has come down to about 13.03%. That is still high, but my portfolio already has plenty of income. I care about both cash flow and growth. Most of my portfolio is still in high-income ETFs. I want consistent cash flow, but I also want the NAV to keep up in a rising market. Many of the high-income ETFs in my portfolio have relatively low covered call coverage. That matters because when the market suddenly rallies, I still want the portfolio's NAV to participate more. Now let me talk about what I plan to buy after selling QQQY. My plan is to split the money into two parts. One part will go into QDAY. The other part will go into ZEQT.T. First, QDAY. QDAY is also a technology income product, but it is more aggressive than QQQY. According to Hamilton, QDAY uses a 0 DTE call option strategy and about 25% modest leverage. Pays semi-monthly, which means twice a month. My screenshot shows QDAY's TTM yield at 16.45% and its forward yield at about 18.13%. That is higher than QQQY's current yield of 13.03%. But I am not buying QDAY only because the yield is higher. I care more about the structure. QDAY mainly holds QMVP. It also holds an additional position in QQQM, with cash and other items creating about 25% leverage. My understanding is that the covered call component mainly applies to the leveraged QQQM portion. The core capital portion, which is QMVP, is not capped in the same way as a traditional covered call ETF that writes calls on most of the principal. That matters because I am selling QQQY to reduce the amount of technology upside being capped. QDAY still provides technology income, but it also lets the core QMVP portion participate more directly in technology growth. The covered call strategy is used more on the additional leverage technology exposure. Of course, QDAY has higher risk. It uses 0 DTE options, leverage, and can be more volatile. This is not a conservative replacement. My original technology exposure in this portfolio was actually QDAY. I later added QQQY because I wanted a more stable technology income position. Now I would rather accept slightly higher volatility from QDAY than continue to let QQQY's 50% covered call structure limit too much upside. The second part will go into ZEQT.T. If QDAY is the more aggressive technology income position, ZEQT.T is here to strengthen the core of the portfolio. ZEQT.T is essentially the T-series version of ZEQT. It is not a covered call ETF. It does not sell options to create yield. It is a global all-equity allocation ETF that uses a T-series distribution mechanism to pay monthly cash flow. The underlying performance should be the same as ZEQT. It does not give up upside by selling covered calls, and it does not have performance drag from chasing option premium. Of course, part of its distribution can be return of capital. ZEQT.T's cash flow is not free extra income. The T-series simply distributes part of the assets back to investors as monthly cash flow. But this fits my portfolio. I do not need every position to chase the highest yield. I need some global equity beta without covered call drag. Many creators have already talked about why ZEQT is a strong all-in-one ETF. It gives exposure to Canada, the United States, international markets, and emerging markets in one fund. It is not exciting, but it is simple. It is boring, but it works. For a high-income portfolio, that kind of core equity exposure is important. So after selling QQQY, my plan is clear. QDAY will continue to provide technology income while keeping more technology growth potential. ZEQT.T will provide global all-equity exposure and reduce the volatility brought by QDAY. After this adjustment, my portfolio will still be a high-income portfolio since the distribution won't reduce too much. Instead of distribution stability, I care more about both cash flow and NAV growth. Especially when the market suddenly rallies, I do not want my holdings to lag too much because covered call coverage is too high. To summarize, QQQY is not a bad product. It can still make sense for investors who want Nasdaq technology exposure, more stable monthly distributions, and a smoother holding experience. This time, I am removing QQQY for two reasons. First, I want to reduce the drag from covered calls. Second, I want to simplify my holdings. If you found this video helpful, please remember to like, subscribe, and I will see you in the next video.